Hi, my name's Steve. Welcome to another Mind Bomb training video. Today's topic is about cash flow and trying to work out if your business is a cash hungry monster. Yeah, this is something I've definitely got experience of in the past, so it hopefully will be useful to pass on some of that experience. Many entrepreneurs seem to fall into a business without thinking too much about what type of business it is. And it's very easy to run into something that develops over a 2, 3, 5 year period of time, whatever it is, and you can really find the business is actually running away with you. So as you grow the business, without really thinking about the structure of it, then that can lead you into all sorts of things in terms of cash flow and financing. I suppose it's natural. You'll see an opportunity, or maybe it's just setting up your own business with the experience that you have, following on from what you've already been doing. And it's obviously very natural to be able to do it that way. But the thing is that a lot of people don't realise that there's differences in the structure of a business. Some businesses, the obvious things, maybe plant and equipment hire, or a printing business where you have to have large printing machines, then those are, anyone can see that it's going to be expensive to get into that, and you to be able to grow it, you need to add to that equipment. But there's others where it's not quite so obvious that the cash flow is going to become more constrained. And the kinds of things that can bring that about might be because you're supplying to customers on credit. If your industry is established in that way, and all of the customers are used to buying on credit, that's what you're going to have to do. You have to then finance the debtor profile that you have for the future. And obviously each time that expands, if your debtors go from £50,000 to £100,000, somewhere you've got to find that extra £50,000 within the business. It may be that it can come from profit. It may be that it will come from the bank. The bank may help you through it. But the truth is that you're going to have to find it from somewhere in order to be able to fund that extra business. So yeah, it's trying to work out the type of business that you have, and whether you fully understand what you're getting yourself into at the start of it, whether you can actually see the way that the growth curve is actually going to come for the business, and also how it's going to bite in terms of the cash flow. So yeah, if you stop and think for a moment, what type of business is it? How can I expand? How can I maximise the opportunities? And in doing so, is my business going to become that capital hungry monster? Is it going to constantly need to draw in more and more cash into the business, which over the long term can be fine. If you're in it for the long haul and you want to build up long-term value within the business, it can be fine. You can actually do that, and you can have a longer term plan. But you do need to be aware of it, and especially if the business is growing quickly. If your business is just relatively slow and you're going from say 500,000 to 600,000 turnover to 700,000 turnover, then it's not too bad. But if you're going from 1 million to 2 million within 12 months, and then maybe from 2 million to 5 million, then those are big steps, and you really need to be aware of the impact on the cash flow that can have for the business. As an entrepreneur, one of the natural things for us all is to want to grow the business as quickly as we can. We all look for the opportunities. It's great when you see something that's working. You all want to push that bit further, and you can start to bring the employees into that, bring the team together, and all of a sudden you can find that the sales can really take off. It's a natural thing to want to do. But in doing that, you need to be one step ahead of the game, and to identify what is going to happen with the cash within the business once you do that. the obvious thing in the early days, then it's very easy to get drawn into the standard scenario where you take some short-term finance, maybe even from family and friends. You can get a number of people to actually chip in and help, and that's often the way that people get started. But that becomes less sustainable as the business grows, as the sums get larger, and there's more people involved, and you need to become more professional and independent, if you like. Then obviously those sources of finance are going to become more of an issue. The other thing that you need to bear in mind about how the business is expanding is whether you're going to effectively put everything back into the business. Is your idea that you can build up a long-term value within the company, which may be great if it's a family business and you want to pass it on to future generations. But really, if you're in that cash-hungry business, you may well find that all you're doing is earning a relatively normal salary, but everything is going back into the company. I've seen examples of that where over a longer period of time, then the company actually swallows up all of the cash that is generated. Any profit that is made has gone back into the company in terms of new plant or new equipment, and the owners can be just taking a fairly standard salary, living fairly standard lifestyle, and unless you have a plan for that, unless you're thinking of an exit plan in 5 or 10 years' time, then it can be very frustrating for the owner. They can quite often find themselves saying, where is the money? How come we can be growing so quickly and expanding all of the time, but we're not actually seeing any benefit of it for ourselves, and that can be very frustrating. So I think, you've got to be very aware of that fact and treat the business accordingly, and make sure that you know that you're in control of it. So let's start with the root causes of cash flow problems within any business. The first one to look at is whether it's profitable. This isn't a structural thing necessarily, but you do need to understand the accounting and make sure that you've got the accounts right. Is the business actually profitable? Is it losing money? Because obviously if it's losing money, then over a longer period of time, that's going to be a serious issue, and will obviously dent the cash flow. And that can be hidden. It may well be there's something wrong in the accounts. Things like depreciation are obviously done incorrectly. It may well be that you've missed out maybe a tax bill. There can be a number of things that can actually be hidden that make the business look profitable. But really you need to go back over this and make sure that your sums are right and that the accountant hasn't actually missed anything in the calculations. So if we assume that the business is profitable and growing, then let's look at the other more structural reasons why the cash flow might be poor. So as I alluded to start with, if your business is involved in significant plant or equipment, so maybe you're a crane hire business or a digger hire business, and each digger that you're going to bring into the business to hire out might be £100,000 investment, or even more than that. Printing equipment, it might be £500,000 investment. So there's a number of significant chunks. So your business might actually reach a plateau, and then you have to add the next lump of equipment, and depending on the type of finance that you can arrange, and the cost of that equipment and so on, it may well be that impacts the cash flow, especially if that's going very quickly. As I say in the example earlier, if you're going from £1 million to £2 million in 12 months turnover, then it may well be that you're actually having to buy 3 or 4 large pieces of equipment. Your impact on the cash flow could be £400,000 significant expense, maybe against a profit for last year of £100,000. So you can find yourself £300,000 in the hole very quickly, and that's before you start to then, at the end of the 12-month period, you should then see the profit come back in, and hopefully, if everything goes according to plan, then you should actually move on to the next level. But whether that means the customers are just asking for other equipment from you, the demand for the equipment might actually drive the speed and the growth of the sales. So it might feel like you're being pulled along, and I know the feeling of almost having the tiger by the tail when you've actually got the customers actually leading the way, and obviously the more customers, more demand, and it feels like you very much have to keep on satisfying that demand. So it may be the investment that you need in the plant and equipment could be the root cause of the cash flow issue. The third thing that I would like you to consider, as I say, is about the creditors and debtors position. So debtors are the people that are owing you money. Creditors are obviously what's owed by the company to the suppliers. And it's normally the way that the creditors are much less than the debtors. So if you're offering trade terms to your customers, your creditor position maybe 50,000 against 100,000 for the debtors. If the business is going to double, you might be able to take some extra credit on the supply of goods, but equally you're going to be giving out a lot more to the customers. So look at that balance, look how close the thing is in balance, and that could be the cause of the cash flow issues. So the more credit that you're giving out, obviously there's more a risk associated with that as well, but it's also going to mean more of an impact on the cash flow. And in fact, if you've got the two things together, whether there's the cash flow profile and the need for investment in plant or equipment, if those two things come together, which they do in a lot of businesses, then that can be a double whammy on the cash flow. Not only are you laying out more money for the next lot of equipment that you need to buy, but you're also then giving more credit on the customers, the very customers that are using that equipment, and that can be a kind of pincer movement on the cash flow, so you feel it twice on that. The fourth issue is to do with stock. There's lots of businesses that are effectively wholesale businesses, especially nowadays with importing overseas. You need to buy large lumps of stock, and that supply can make it quite chunky. But it goes through the same kind of processes with the large chunk in terms of asset purchase. The new stock will come in, and if you've got the right stock for the right customers, that will drive the growth. So the sales are going to increase, which is great, but equally it will draw in more stock. So the more customers you have, the more stock that you need to support the sales and customers in the first place, and that will have the same effect. So your stock position might go from, let's say, £100,000. Within 12 months, you could find yourself in a position of holding two, maybe even £300,000 worth of stock. So it could be a couple of £100,000 needed. And again, if you're only generating £50,000 or £100,000 profit over the year, then you're going to need financing to cover that gap again. And it's something that a lot of people don't realise and don't think about too much in terms of the stock build that you actually need. Sometimes you can speed up the turn. If you're growing the customers, then it can help if you can turn the stock more regularly. If you can get people to commit in advance to orders so that as soon as it comes in, it's shipped straight out to the customer, then all of those kind of things can help with the ratio that you'll actually turn the stock over in terms of the sales. So what can you do if you find yourself in the position that I've described? Obviously you've got to be aware of it and think about it in advance, but there are steps that you can take, I'm pleased to say. So think about these, make sure that you're actually considering this if you find your business is the cash hungry monster that I've described. First thing is to make sure that you're planning for it, so proper planning. You need to be talking to the accountant or bookkeeper, whoever can actually do you the cash flow planning. If you don't have the skills in-house, then make sure that you've actually got those numbers down. You can work out the graph, rough idea of what you're going to grow from this year to next. And really, you should then be able to work out exactly where your increases in stock are going to come, or your new asset purchases, So it may be every other month that you're adding another £20,000, £40,000, whatever it is in terms of the asset cost or the increase in stock. And that will help you then to predict exactly where the cash flow issues are going to come. It can also, as you build that picture, it can also help you with the timing of things. You might have some seasonality issues to take into account. So you might have a big peak as it comes up to Christmas, or equally over the summer you might find that either it's quiet or it's even busier, depends on your type of business. So those have got to be built into the cash flow forecast as well. But make sure to do some proper planning, get the full picture so that you can see over the next 12 months where your pinch points are going to be. And it should also give you a figure that you then need to think about how you're going to finance. But at least you can do all of that in advance. You're much more likely to get a positive response from the bank or the finance company if you go along in advance and say, this is my plan for the next 12 months, this is where I see the pinch points, this is how I see it developing. If we can get there, then we're going to double the sales and we're going to double the profitability of the company. All of that should paint the picture for the bank, and they're much more likely to give you that than if you just carry on regardless, and then all of a sudden you go along to them and say, I've hit the wall in terms of the finance, I need an overdraft, I need it tomorrow, I've got to pay for the stock, I've got to pay for this, I've got to pay for that. If you've made commitments blind without actually putting the finance in place, then you're going to have much more of a headache, much more of a serious problem with it. That's the second thing that you can actually do is to stop growing. It's a perfectly valid part of the business plan. If you're profitable and you're finding that your business is growing very quickly, then it seems counterintuitive, but you can actually certainly defer the growth. You don't have to make the investment in the new equipment. You don't have to be pulled along by the customers to keep on bringing in more and more stock all the time. It may well be that you can actually plan a year of consolidation. So, you're not adding to your salespeople, you're not actually pushing the sales team. Look to see whether you can actually think about the next 12 months to consolidate your position in the market. And if that's perfectly valid, then it may well be that that's part of the plan. So think about whether you can do that as well to stop the growth for a period of time. So third thing about what you need to do, as I alluded before, finance. You're going to need some finance if you're to continue the growth, and it's much better to do that in advance. Organise the proper finance, make sure that you've got it on sensible terms, and that it's not some kind of ramshackle arrangement of asset finance, loan financing and overdraft financing and even credit card financing. If you can actually put in a proper written plan, as I say, it's much better to think about it over the 12-month term, do it in advance and make sure that you're getting a sensible interest rate that way. And plan the growth accordingly. Make sure that you've got the necessary finance in place that you're going to need to be able to hit the growth targets that you can then set. Number 4 about the things that you can do to mitigate the cash flow issues. I quite like this one. Number 4, you can actually take advantage of the extra demand. So all the while that you're assuming that growth is coming, then there must be underlying demand within the customer base. People obviously want more of whatever it is that you're doing. So you can take advantage of that. If you want to slow that growth, restrict that growth slightly, then you can raise the prices, or you can look at less profitable contracts of supply. It may well be the time to turn around and say, no, we're not doing that anymore. Then you can actually move the asset, move the equity that you've got to more profitable contracts and more profitable customers. So use the time to assess all of the sales that you have and see whether you can actually put more behind the more profitable ones and less into the less profitable ones, and maybe even walk away from some contracts if they're not generating you the profit that you need. So you can improve your profit margin that way. Overall, it might take some while to feed through, but it can help in terms of the financing. Instead of previous year you might have only made £50,000. This year, if you can double that and make £100,000 on the same underlying business, plus whatever you'll make from the extra sales, then it can make a big difference to the finance as it flows through the year. Point number 5 I've got is a similar point, but slightly different. It's actually to take advantage of economies of scale. Again, it's something to do with the growth of the business. If the business is growing quite strongly, you're likely to be buying more, whether it's more assets, whether you're going back to the same supplier of the key assets for the business, then you may be able to actually renegotiate and get a better deal. If you're buying half a dozen cranes over a period of a year or whatever it is, you might actually find that you're able to negotiate a better deal. And the same with the supply. If all of a sudden you're bringing in twice the quantity of stuff from overseas, you might be able to bring it by sea rather than by air, forecast a little bit further forward, and bring in larger quantities of the key items of stock that you're importing. And that way you can actually save quite a bit of money, quite apart from the deal with the manufacturer. So it may well be that you can actually use the growth to look for those economies of scale, and again, improve the profit margin is what you're actually aiming to do. So the underlying margin on the business should improve overall. And finally, in terms of the steps that you can take, it's quite a radical one, but really you need to think about, having identified the structural issue for the cash flow problem within the business. Is it really what you want to do with your business life? If you're looking into the future, and if you're having this problem now, you're likely to face the same problem again in 2 years, 5 years down the line if the business continues to grow. So think hard about whether you want to actually continue in the same way. It might be that you actually want to make a definite plan. So you might be happy to run with the building the value of the business over 5 years, and run to keep the growth going as much as you can. But maybe 5 years is the end of it. Maybe you sell the business, and that's part of the business plan. But think hard about whether you actually want to continue in the same way, because if it's a structural issue about the cash flow and the growth of the business, that's not going to go away. It's effectively just going to get bigger and bigger as the business grows. So it's definitely something to consider. Maybe you bring in a partner into the business. Maybe there's a point where you're going to look for outside investors and other ways to actually raise finance on the business. But certainly you need to think about it as the owner. Then definitely think about it and plan further forward. Think about the longer term impact on the business for the future. So we should understand that all businesses are going to get cash flow problems from time to time. But the point that I'm making today is to try and work out whether that is down to seasonality, whether it's down to some particular bad debt from a customer, or a particular short-term problem, or whether it's a structural problem within the business, and you need to plan for it accordingly. As I say, it's very easy as an entrepreneur to get drawn into a different type of business without really thinking too much about how the business is going to grow in the longer term. And it's only really when you start to be successful and that business actually starts to blossom and to grow that you find out how much the business has become that cash-hungry monster. So think hard about that, and I just hope this has helped you to identify it, and then to start looking at the potential solutions and whether you actually want to make that a long-term commitment. So I hope you like what you've seen today. Hope it's been worthwhile, and don't forget, if you haven't already subscribed, make sure to subscribe, and of course you can now follow us on Instagram and Facebook as well. So hopefully see you there, and thank you very much for watching. See See you next time.